Thank you for sharing your lunch hour today with us. My name's Jeff Hunter. I'm an associate investment advisor or investment associate and portfolio manager with the Townshend, Somani and Hunter Group. Also on the line, we have Raheem Somani, senior investment advisor, and Dave Townshend, senior investment advisor. Today's an exciting call. We have Ben Fawcett. Ben joins us with a wealth of experience and a great track record with a team that has outperformed the benchmarks over the longer periods of time. He's a very strong resource for us, and he's also a huge complement to our MyWealth global strategies. Ben, I want to tell us a little bit more about your background, what brought you here, and what we should know about the markets.
Will do. Yeah, thanks, Jeff, for having me on, and thanks for everyone for logging in and listening in on this. Bit of background from my standpoint, and this sort of will tie into the fund. 20 years sort of investment management experience, about 15 leading sort of multi-billion-dollar institutional funds, pension money, seg money, insurance money, and some mutual funds. And I think one of the interesting parts about it that ties in with this fund that I'm going to be talking about is that I actually started out in a quantitative role as a quant analyst and using quantitative process to run funds, and then went deep dive on fundamental after that. So it's sort of combining those two disciplines, which I'll sort of dig into a little bit on our process. Perhaps just if we want to sort of move on, I'll just tell you about the team first, and then give you a quick overview of what we're going to talk about for the next 20, 25 minutes, kind of. So if we skip to slide 2. Here's the team at Investment Advisory Solutions that runs this and a few other funds. It's headed up by Kevin Vandermeer. He was formerly RBC, where again he ran multi-billion-dollar portfolios. And then we got a couple of very sharp guys, Mathan, who's been with the team for 3 years, and Drew, who's been on the team for about a year now. So that's a great team we have here. I'll just run through the agenda on slide 3, just what I plan to sort of go through. First off, give you a quick overview of the portfolio, a few key areas that you sort of need to know, why you want to own this fund and what differentiates it, where its edge comes from. I'll talk about the investment process, again, some of those fundamental and quantitative sides. I won't get too far into the details here. Kevin did point out that while investment committees love to go through the depths of risk management and process, not everyone is enthralled by that. So we'll keep it moving from that standpoint. And there's a lot going on in the market today and recently. So a whole bunch of subjects I want to touch on there. And we can run through those thoughts. I strongly encourage questions throughout this, so you can put them on chat or just throw them out there. And if we can create a discussion, that's great. So yeah, happy to talk about anything that's sort of top of mind. So maybe we'll skip to slide 5. I'll give you a quick overview of the fund. Just a second. Mathan, do we have the slide up there?
Yep, it's showing there.
Oh, there we go. Sorry. So first off, we'll be talking about the CG Wealth Management North American Focus Equity Portfolio. A couple of sort of key points as far as this. This is basically why invest in this fund. It's for those seeking broad North American equity exposure to larger cap, high quality names. There's a very rigorous process, which I'll touch on. We control risk, manage volatility, and again, it's a sort of high quality, low volatility, strong return type portfolio. As far as a couple of other aspects to mention, one is geographic mix. We benchmarked against the TSX Composite at 50% and the S&P 500 50%. It's a really nice mix that actually, having managed both over the years, both markets complement each other in a lot of ways. We're seeing a lot of strength in resource markets right now, where there's very little in the S&P from that standpoint. But obviously, there's some other sectors where Canada and the TSX are somewhat deficient. So, we have that ability to sort of jump back and forth between those markets. That said, we do tend to keep the mix roughly at a 50-50 geographic allocation. Right now, we're weighted a little bit more to the US at 55%, but it's pretty close to that split. So it's really broad North American exposure. Couple of other aspects. It's fairly concentrated portfolio, so you're getting that broad North American exposure with, you know, anywhere in the 45 to 50 type stocks. So it's quite a big focus on stock picking, which is sort of ties in with my background a lot. Diversification too. We try and avoid big macro bets. If you have a big macro bet, you know, the portfolio tends to move one way or the other way depending on what your outlook is on the broader issues. We look for good stocks in a broad array of sectors, and that way, you know, it's a bit of an all-season portfolio. So we're not going to make a call on what we think the Fed's going to do or necessarily some other macro event. It's about picking good stocks and letting them do their thing over time. As far as performance goes, the 1 year is first quartile versus peers, 2 year is second quartile, and we're a couple months away from the 3 year number, so we'll be getting that soon. So perhaps I'll move on now and I'll just dig into the process a little bit from here. So starting with slide 7 and the process overview. I'll break this down into 2 aspects. One is how we pick stocks, the research side, and then how we actually put the portfolio together, which is also very important because that's where a lot of the discipline and rigor comes together, and risk management side of it. From a research standpoint, there's 2 areas, and this is, I started out again on the quant side, and I think it does bring an interesting perspective. If you're a quant analyst, what you do is you start out with a thesis. What's my edge going to be in the market? How can I add value? And then you back test and you test it. So there's a real sort of rigor in process and detail that comes with that. So that's the first part. Then there's the fundamental side that we layer on, which I'll touch on in the next slide. So maybe if we move on to slide 8, can sort of dig into these in a bit more detail. Again, starting with that quantitative side, that brings a lot of the rigor and discipline to the process. What we do here is we screen the universe of the S&P 500, TSX, on a whole bunch of different characteristics. Some have to do with valuation, some have to do with quality, volatility, momentum, and there's a scoring process that comes with that. So that sort of really makes sure that we're walking the talk and doing what we say we're doing. And it's at the same time, it's a real-time monitor so we can see what's going on in the market. And we get signals, you know, time to look at this stock and evaluate it. The fundamental side has always sort of been the fun part for me. I love to understand businesses, how they work, what's the edge, what makes them work and what doesn't make them work. And that's where we sort of combine the 2 here. So I'll give you an example. One is Republic Services. We've got a few excerpts on the right there. That's from our quarterly report in Q1. On the top left of that box for Republic Services, this is a waste management company. It doesn't sound very interesting, but for a number of reasons, great business, long-term business. You can see a scoring system on the left with the green and the blue. That sort of summarizes a lot of our quant model work. One thing I highlight there is the valuations in blue at 291. Valuation is a bit higher on this name, and so it doesn't rank that well in the US. However, the other side of it is the valuation, or the fundamental side comes in to our process at that point. And just to talk about the stock very quickly, basically, like I said, it's waste disposal. If you own the landfills, you can't get a new landfill in the US anymore. It's very difficult due to permitting. So if you own that, you can basically control the whole waste pricing system, everyone coming into that landfill. And what you get with companies like Republic and Waste Connections in Canada is a lot of price control, a lot of pricing power. So they'll raise prices often a couple of times a year in an inflationary environment, even more. So it makes it a really durable investment with long-term growth that's very consistent. That probably just the last bit on the process slide here. If I'm sort of looking at all the different ways I've looked at investing over the last 20 plus years, there's a bit of a touchstone, I suppose, for me, and you'll see this bias in the portfolio as far as, you know, ultimately, what am I looking for? And I'd sort of define that as high quality companies that can reinvest capital back into their own businesses. That's the ultimate way you create long-term shareholder value, from my experience. And that's something I'll always come back to. You know, Waste Management or Republic Services would be examples of those sort of companies. They're very good returns on their capital base. They're great businesses, very defensible in all types of markets, and they keep growing their own businesses, reinvesting in that, compounding that cash flow. And you can stay with those companies, let them generate cash, reinvest it back in the business, do that rinse, repeat a few times, and that compounding cash flow will just nicely grow over time. You don't have to trade it as much, then you don't have the same sort of tax implications. There's a lot of benefits to those sort of companies. So that is one area specifically that, you know, a sort of bias that will come into the portfolio. Perhaps I'll just very quickly touch on a couple of aspects from the investment process, and then I'll get into the markets. I won't go through this slide in detail. Couple key points though. One, diversification is the free lunch in the market. That's why, you know, we'll have 40 to 50 stocks, and we'll make sure we have an active position in a decent sort of active position in each one. You don't want a portfolio that comes down to, say, 3 stocks. It can be extremely volatile. And so we try and get that free lunch as a diversification from a stock standpoint, and also to some extent from a sector standpoint too. Try and find good companies in a broad array of sectors as you can, because it does sort of reduce the volatility while not impacting return. And the final thing is, I'll just highlight disclosure. With this fund, there is a monthly update we put out, as well as more comprehensive quarterly commentary. And the final process slide is the risk management. It's very rigorous. Rigorous is the quick description of it. Again, sort of coming from both my and Kevin's background from that institutional standpoint. A couple of sort of things that probably the 2 points I'd say is the fundamental analysis and quantitative analysis. Ensure that you have good companies with cash flow and balance sheets. That's a huge aspect of reducing risk. The second is a sell discipline. You can sell a stock for fundamental reasons, the thesis played out or it didn't play out and you want to change. You might, for a tactical reason, a sort of shorter term sort of reason. There's also just sometimes you have to admit something's going on with the stock. I don't fully know what's going on. We'll sell, move on. You don't want to sort of be writing the stocks down when you don't understand what's going on in that situation. So sell discipline is probably one of the most significant aspects I've found over time for the risk management of a portfolio. I'll leave it there before I get into the market. I don't know if there's any questions, Jeff, anything. Otherwise, I'll keep going.
No, I think maybe some of the ones in terms of you're more concentrated than what you would see in a broad ETF or the sort. What are the benefits for being more concentrated while diversified across sectors?
Sure. There's a real
perspective.
Yeah, there's a real balance there. If you get too diversified and too broad, then obviously you lose those opportunities to generate alpha. At the same time, you spend a lot of time selecting the stocks that go into a portfolio. So when you decide, yes, this is a company that I like, I think there's an investment thesis that's interesting, I think we have an edge on this investment thesis, you need to make it meaningful. And that's that balance. And so, you know, that's why we might come in with a 3% position or something that's meaningful, but we're not sort of betting the whole portfolio on that single position. At the same time, you also want some diversification across sectors. So that's where I find, especially in North American portfolio, you're dealing with a universe of, you know, about 750 companies, probably, if we're looking at TSX combined with the S&P 500. And that's the sweet spot, I find.
Also time frame. So you're looking at owning an investment. What is your ideal investment timeline in the portfolio? I know turnover sometimes can create tax consequences, but it's also can be used to redeploy capital into better theses.
Yeah.
What's your thoughts on holding timeframes?
optimally, I've always sort of looked at it 3 to 5 years. So if I'm sort of modeling out a company, I ask myself, what earnings stream do I think this company or cash flow stream do I think they're going to have compounded on a 3 to 5 year basis? You know, I'm looking at 10% plus generally, 10 to 15% would be a sweet spot if I can say I can see line of sight for that. So a 3 to 5 year holding period, longer. There's some positions I'll own for much longer. At the same time, you have to be willing to sell a position. Things do change. So if things start to change, yeah, again, you have to be willing to sell, and we're definitely willing to do that. So, but longer is always better in my view.
And again, anyone in the audience, there is a Q&A button at the bottom of your screen. Just type something in there. We're happy to ask on your behalf.
Okay, perfect. Okay, I'll keep moving on. Some market commentary then. Perhaps if we go to slide 12, I'll talk about a few different themes here. The first one, perhaps, and it also sort of speaks to how we invest to some extent. Looking at the US and Canada, we've had the Fed minutes yesterday. There's a lot of commentary as far as rates, impact on the market, inflation, jobs, etc. Probably the way I look at it, or the best way to look at it, is I spent a fair bit of time on the macro side, but it's not necessarily to generate performance. It's more from a risk standpoint. So if I'm looking at what the Fed is going to do, and everyone has their view, and at the start of the year, the market thought the Fed was going to cut 7 times, and now it thinks it's going to cut 1 time this year. I'm going to paint a number of different scenarios and I'm going to look at how the portfolio is going to deal with those different scenarios. You know, what happens if the Fed doesn't cut this year? What happens if the Fed does cut a couple times this year? What happens if the Fed goes into a tightening bias? So from portfolio standpoint, I'm looking to manage risk. I want the stocks to ultimately do the hard work and heavy lifting in the portfolio. And I don't want that to be sidelined by a big sort of macro tilt in the portfolio to some extent. So speaking of what do I think the Fed's going to do at this stage, I'm actually pretty constructive on the market. I'll take a step back perhaps before we get into that side and just, you know, what's the market telling me at this point? 14 of the top 20 indices in the world approaching or at highs. If I look at, say, emerging markets ex-China, we're near highs. Japan, around the highs too. Europe, UK, India, Brazil, commodity markets, copper highs, zinc perking up, some of the ags showing signs of strength, gold at highs, US markets around highs too, be it the Dow or the S&P or the NASDAQ. Even some of the small caps, which we were talking about, are starting to show signs of life. They're definitely not at highs, but we're seeing some signs of life. So when I step back, I sort of say, you know, the market's telling me something, that there is this sort of broad global backdrop that is constructive. And then, you know, I'll dial that into, you know, what do I think from a US standpoint at this point? For what it's worth, my take with the US right now is, again, the Fed would like to cut. They're really watching inflation, whether they get to. Let's play 2 scenarios. One is inflation doesn't come down the way they want it to. That means economic growth is pretty strong. So we're going to get good earnings growth. So that's pretty constructive. Let's say that inflation does start to slow. Perhaps there's slightly slower economic growth, but rates come down. That's good for the valuation side. So in those 2 scenarios, actually, I'm pretty positive on the US market. I'll move on to the next slide, just touch on aspects with Canada. A little more constructive on Canada probably than a lot of people. Obviously, everyone knows about sort of debt levels of Canadian governments and the Canadian consumer. And, you know, we've seen that in slower growth, slower productivity. A couple of other aspects to consider from that standpoint. What's the Bank of Canada going to do? They are to some extent limited by what the Federal Reserve, when they cut, because if they cut interest rates a lot lower than the US, the Canadian dollar goes down even further from here. I do think that the Bank of Canada will be cutting. My guess would be in July, and then probably later again in the fall another time. And then we'll see what the US does before they go from there. But overall, I think there's a couple of aspects to consider from a Canadian perspective and why it's worth being more constructive. One is, if you look at bond yields, they're a lot lower in Canada. So the market effectively has priced in lower rates and to some extent that lower economic growth. And you see that in valuation of Canadian equities as well. There's a couple of offsets here though. US economic strength is very strong still, and that's going to help prop up the Canadian economy to some extent. And then the other side is we are seeing strength in commodities. Oil, which I'll touch on, is still a bit range bound, but generally those have been pretty constructive for the Canadian dollar and the Canadian economy, obviously. And so, yeah, I think that there's some interesting opportunities on the Canadian side as well at this point. A lot of bad news is priced in. Touch on commodities quickly on slide 14. Again, sort of mentioned that broad strength we're seeing, some of that reflationary force. Copper has been very strong due to a few supply issues. So there's a couple of separate things going. The long-term prognosis there is actually very positive though. And we're probably tying it in at this point with increased electric demand, and that ties into data centers and AI as far as the sentiment side. But the market itself is physically very tight at the moment. I won't touch on gold and wheat just right now due to sort of time, but happy to sort of go back to those. As far as oil, in my view, is sort of range bound at the moment between that $80 to $100 range. Demand is good, around 105 million barrels a day potentially this year, which is strong when you consider that a couple of years ago, global oil markets were supposed to peak at 110 million barrels a day by 2030. So we're well on to that target, and it may get surpassed. The issue right now, I'll tie back to the US election to some extent. OPEC Plus does have a fair bit of excess supply that they're holding off the market. And I suspect with the US election, the US incumbent doesn't want oil prices or gasoline prices to be too high, because that will hit them at the polls. So there's probably some pressure on OPEC Plus to not tighten the oil market too much to some extent. But I think once we get past November, you might see them sort of act again to sort of push oil prices up towards that $100 level where I think they would prefer them to be. Move on to slide 15, just touching on the US election. A couple of observations here. The market at this point is sort of taking the view that both are known quantities. And so the ups and downs in the election hasn't, and the polling hasn't actually been impacting market movements a lot. There's a couple of other factors to consider. One is, and this is something the Fed's been dealing with their higher rates aren't having the same effect that they might want, just because there's so much stimulus in the US economy. There's a couple of very big acts out there with a lot of spending, and that money is going to be flowing for a few years. One question would be, does the election change that? And to be honest, if Biden wins, he put those bills through. If Trump wins, I don't think he'll cut too much either, just because, stimulus is ultimately good for economy, which is good for a president. So I suspect most of that spending continues in the US. Both candidates would be supportive, especially Trump, of loose monetary policy and lower rates. I don't think we'll see any huge changes there. And then ultimately, election years have consistently been good for US equities. And I think that is because incumbents, to some extent, make sure the economy is doing well. Because if you go into an election with a weak economy, the incumbent rarely wins. So you've got a pretty constructive backdrop from that standpoint. If you look at the chart on the right, you can see there's a little yellow arrow. The red line basically shows an aggregate of election years and S&P performance. And usually we get a downdraft, and then you want to be buying the market generally around the start of June historically. You could say maybe the market preempted that a couple of weeks this year with the strong rally we've had recently. But historically, anyway, for what it's worth, it's been a good time to be in the market. moving to slide 17, sorry, 16. Just wanted to touch on AI, a whole bunch of different thoughts here. I suppose I'd comment on it, NVIDIA at this point. My very quick thoughts there is you've seen this huge earnings growth over the last basically year. If I look, earnings went from $5 to $25. It's huge. And if I look at next year's expectations, NVIDIA is trading at around 30 times earnings, which isn't a crazy valuation for a stock that holds that position, that growth. That said, take a step back, who are those customers? You can see on the chart there, the main customers would be huge companies like Microsoft, Meta, Google, Amazon. These are companies that spend approximately $50 billion a year in capital. So the customers are strong and the cash flow is there. So those are all good. The one thing I'm watching as far as NVIDIA is pricing. They've grown their earnings, not necessarily through volume, but it's through huge demand for their chips and everyone bidding up those chips. So pricing would be the one big risk. Otherwise, from valuation standpoint, I was there in the 90s when we had the tech boom, and this doesn't look the same. There's real cash. I mean, NVIDIA is expected to do 60 billion plus in free cash flow next year. So there's a lot of differences here, but pricing would be the one thing I'm really sort of keeping an eye on. A couple of other sort of points. We're definitely in the picks and shovels phase of AI right now with chips, moving to some extent to edge, which would be more on your mobile devices. Companies like Qualcomm are doing well. And then there's, also who's going to supply the energy. And we're seeing that in a number of the utility companies too. Do the winners keep winning? NVIDIA, Microsoft, Alphabet, Amazon. I definitely think they will to some extent, just because the amount they can spend on this. And if you look at, say, Google, Microsoft, Amazon, their cloud business is a huge, very high margin, very defensible, very difficult for anyone to attack. So I think those will have long terms over the next 5 years, good solid earnings growth. You can sort of look at 15% compound annual with those names. As far as the next phase for AI, and this is the bit I don't know on the timing will be, but we're definitely looking at areas of biotech. Some of the consumer areas will be interesting. Media, for example, something like Netflix or Disney, you can start using AI to create content. And once those content costs come down, you get huge earnings leverage. The one sort of key aspect with this is I've been following AI, I suppose, since 2017. I think I really started digging deep into it. And again, it was to use quantitative models in the market and talked to a lot of people at the time. And then I've followed it since. Last year when GPT-3 came out, I was somewhat blown away actually by the impact and what it was capable of. The big question in my mind will be, is GPT-5 going to be another step change like that? Seen other technologies, say voice to text, where you could get to 95% pretty quickly, but that last getting you to 98 to 99%, which is where you need to be, the fidelity you need for these sort of things, took another 5 years. Autonomous cars, Google's Waymo has been driving around Phoenix for more than 5 years now, but we just haven't seen them on the market, which if I go back, say 7 years, there was an expectation that, they would be available by this stage. So those last little steps can take a long time. That said, I do believe the technology is coming and 5 years happens pretty quickly. So I don't know if it's going to be later this year, next year, or 5 years from now, but as a theme, it's definitely, really exciting to some extent. The last quick point I'll make on that is AI does have a bit of an ESG issue, and this is why you've seen Microsoft team up with Brookfield. There's a huge demand for renewables to power these data centers, and that's going to be a big issue. Those sort of companies, they have a lot of money and they don't want the sort of carbon footprint aspect that's going to come with AI. And so they're going to be spending a lot of money in the renewable space, and they have a lot of money to spend. I'll just try and sum things up quickly as far as from a market standpoint. On the chart there, you can see cyclical bull markets. Cyclical bull markets tend to sort of go 3 to 4 years on average pretty consistently. We're nearing 2 years now. overall, I think the markets have started to price in a soft landing where you've got pretty good economic growth. Rates will probably come down a bit. So valuations are starting to factor that in. What we need at this point is we need the earnings growth to show up. Got a strong economy, you need earnings to come through. And that's what happened in Q1. Earnings were actually very strong, and analysts were taking up estimates and expectations for the year. So as far as sort of where do I see the market, I see the market continue to move up with earnings over the year. I don't think we have the huge moves because some of that valuation aspect is already in there, but I think we'll get strong returns through the rest of the year just as the market runs with growing corporate earnings. A couple of sort of key areas, obviously. One is what happens to inflation, how sticky is it? That's going to be, you know, do we get down to that 2% level? I think that could be difficult. And the other side is, you know, do these higher rates at some point start to stall the US economic growth, which we haven't seen at this point. But yeah, overall, pretty constructive on the market at this stage. Couple of sort of activity from Q1 and more recently as far as what we've been doing in the portfolio. We were underweight some of the interest rate sensitives. Those might be utilities, the pipelines. So we have sort of been increasing exposure there. Not working today with rates moving up, but you know, our overall view is that rates are either going to go sideways or down. So that should be supportive of more interest rate sensitive companies. Energy pipelines in particular is one we've been adding for much of the year. It was sort of beaten up, and when you sort of look at the yields and the sort of prospects for energy, pretty constructive on that space. Same with some of the commodities in Canada, and this is where having that North American aspect is great because, you know, there's lots more companies to look at from a Canadian perspective on the resource side. We did trim some of the software areas, but definitely staying on chips and some of the industrial areas too, partly on valuation. And then, you know, the consumer has been very mixed. Some areas in the US are very strong, other areas, obviously Canada, not as strong. Though, like I said, some of the Canadian names are actually looking pretty interesting to some extent. And actually US financials, I forgot to mention there, due to a number of reasons, be it the rate outlook, strong economic growth from the consumer in the US. Some of the US financials are doing very well. American Express is one we added earlier in the year, and Bank of America. We also put out, just to touch on this, it's a top pick list that we put out at the start of the year. I'll leave it there. Broadly speaking, the names have been doing pretty well. So not much to sort of comment on. You know, again, these sort of have a 1-year window we look at with these picks. So if anyone sort of wants to see some names that we like, by and large, most of these names are still looking pretty good from our standpoint. So I think these tend to be higher quality, you know, buy and hold type names. And finally, just wanted to sort of touch on a couple of the other funds. There's 4 funds we manage. So there is this North American fund, which is 50-50, like I said, US and Canada. There's also a Canadian focused portfolio, Canadian dividend focused portfolio, and then just an S&P US portfolio. So some really, really interesting funds there with great performance. And with that, yeah, I'll hand it back if there is any sort of questions or any way you'd like to dig in more.
So some of the things I just wanted to queue up on when you're talking about the funds, they are direct ownership in the equities themselves. So there's full disclosure over when things are happening. And there's also tax advantages. It's had great growth since the inception of it. You're not paying other people's gains. So when you're getting into the portfolio or even exiting, they're your tax positions. I know we've had a very long run since 2008, and some funds have generated some longer term holds that have a lot of potential tax consequences within them when you purchase them. And you're avoiding that with this. for instance, Ben's owned NVIDIA for a while now, and it's got a pretty strong gain behind it. That's something to consider, especially with some of the changes that have happened more recently in our country. So it's a quite a strong advantage on that, and there's some other tax benefits in non-registered accounts, such as fee being able to write off the fees on them as they're paid directly. So you get the benefit of it, and the sort. Some of the things just on the macro side, I know you're talking about companies themselves. The AI trend seems to be more than just a trend, but a new paradigm. We're already noticing it in our business. Just simply, we can now record calls and have summaries built within a matter of seconds, as opposed to taking notes, transposing them, sending them out. It's a big time saver where we can spend more time evaluating companies and strategies. Do you see as a potential risk, especially in Canada, we're talking about policy divergence, where we're in a little bit of a weaker state because of our debt loads with the US, where we have to stay higher for longer because of the strength in the US?
From a currency standpoint, then?
Currency and rate stand.
Yeah. I think it's definitely an issue that the Bank of Canada has to grapple with. That said, I mean, Martin Roberge, Canaccord strategist, puts out some great charts looking at speculative positions, for example, in the Canadian dollar. Sentiment is very negative. I think the fiscal situation Canada is in is well known to some extent now. It is definitely a challenge. So I think currency markets, for example, and bond markets have started to reflect that difficult position. But yeah, I don't think the Bank of Canada, I think they can cut a couple of times before the Fed goes. But after that, I think it does get difficult. So they may have to keep rates a bit higher than they would otherwise like to, which again is a challenge for the Canadian economy. Ultimately, I always come back to the fact that if the US economy is doing well, Canada tends to do quite well too, just because they are a big trading partner. So that does provide a lot of support.
Do you see what policy changes or structural changes would be needed? It seems as though the foreign investments are at lows in Canada for some reasons. What would it take for them to come in? I think it would be kind of not the opposite of black swan, maybe the unicorn. I don't know what the other way on it.
It's a sort of black swan, the opposite, exactly.
Yeah, what would it take?
I mean, to some extent, we've got elections next year. That would be the obvious place that you could get something changed. Canada does have a big structural issue, and maybe too often we compare ourselves to some European countries and tax policies there. The reality is we are right next door to the US, and capital can go back and forth. Canadians can go back and forth. So we do have to maintain a certain amount of competitive tension with the US. And I think that's where some of the productivity and investment standpoints in Canada, there's a couple areas. One is regulation. There's a lot of protected businesses here, be it some of the big banks, insurance, grocery. You go through the list, the telcos, which that's changed. So there's that aspect. But then you do need to incentivize Canadian companies to invest, to take risks, and there needs to be that return. And if your tax policy isn't appropriate, that's going to stifle that, and people are going to spend that investment elsewhere. And also the other problem with Canadian companies is how many national champions grow up. Too often you get an interesting technology. We have some great universities here. I mean, we were really leaders in AI. Some of the founders of that sort of area come from U of T from 20 plus years ago, except those companies tend to get bought out for a couple of $100 million by US companies rather than growing them here, which is one thing I'll credit Shopify with. That's actually stayed here. And you got the controlling shareholder, the CEO, who's actually, kept that as a Canadian company, but we don't see that enough. Long-winded answer.
No, we actually know it quite well. We have one of our smaller cap growth companies, professor out of U of T. So
Jeffrey Hinton or any of those?
No, is in a different discipline. Dave Do you recall his name? Dr. Joseph Garachi.
Okay.
But yeah,
I
he
mean,
started.
world-class program though. Yeah.
Yeah,
And
absolutely.
Canada, you know, where are those AI companies in Canada? And, you know, they just don't tend to stay here. And we've seen this with so many industries over the years too. So I think that's a huge challenge from a policy standpoint.
I remember in Vancouver, we were connected with a small venture capital growth unit, and basically it was go down to Silicon Valley, sell your company, exhaust all other avenues, and then list in Canada and stay in Canada and go with that if all those routes failed. It's like,
Yeah.
doesn't quite
Yeah.
make it sound like a great investment thesis if everyone's already picked through you. So
Yeah.
totally makes sense from that. I know you're more North American focused, and that's where the companies are, but a lot of companies are international
Mhm.
in their domain. What are your thoughts on the global markets, some of the emerging markets? They haven't been well, it's basically been US led up until this point. What
Yeah.
are your thoughts on having a global growth cycle?
Number of the emerging markets actually started to raise rates. They experienced inflation quickly and started raising rates faster, say the Bank of Canada or the Fed did. So they're actually on cutting cycles at this stage. So you're actually seeing some of those economies are doing quite well. And that's why, you know, we have seen markets like India, Brazil, those markets do very well. China is sort of the big question mark, and there's some huge structural issues there. My call would be that China's probably put on a bottom. You're starting to see more stimulus from the government. I think they will cut rates in China too, but they need the Federal Reserve to do that because they have to protect the currency to some extent. So I think there's a bottom in China, but I don't think it's going to be a rapid rebound anyway, but at least it's moving in the right direction. That's the key aspect. So, I mean, you know, when I look around globally, it's seeing a real sort of broadening out from the US to some extent. Now, US companies have a lot of global exposure. You know, the ones we own tend to have at least 50% of revenues from the globe. So, and you benefit from that way, but in a sort of US package, which can be good from a capital and a legal standpoint and other aspects. So, yeah, it's looking constructive.
If there's any more questions in the audience, I think we're through the Q&A part. Feel free to reach out to Dave, Raheem, or myself. We're more than happy to talk further on any extent. For those of you that want to watch a replay, it'll be coming in the next couple of days. And with that, have a great rest of your lunch hour. Thanks a lot, everyone.
Thanks very much,
Thank
Jeff.
you, Ben.
Thanks for everyone for listening in.